This podcast is solely for the attention of institutional, professional, qualified, or sophisticated investors and distributors.
Hi everyone, today we'll talk about the Fed Monetary Policy Committee of May the 4th, 2022. Before starting, let's recall the context that prevailed at the time of this FOMC. The Fed had already raised its key rates by 25 basis points in March by raising its Fed funds target range to 0.25–0.50%. The FOMC members were very tempted by a 50 basis point rate hike, but the rise in uncertainty caused by Russia's invasion of Ukraine had led to a hike of only 25 basis points. Since the March FOMC, the Fed's favorite inflation measure, the core PCE, has decelerated very slightly, falling from 5.31% in February to 5.18% in March. The ISM activity surveys deteriorated a little, while remaining at good levels. There was also the publication of a negative GDP growth figure for Q1, even if the domestic demand seems robust. But above all, the so-called financial conditions have tightened. The S&P 500 has lost around 4% between the two committees. High-yield credit spreads have widened by around 50 basis points, and mortgage rates came back to their highest level for almost 15 years. So the backdrop for this FOMC was that inflation seemed close to its peak, and financial and economic conditions were tightening. Let's start with what did not surprise. The Fed has officially announced a balance sheet reduction policy, which will begin on June the 1st, at a pace of 47.5 billion per month in June, July and August, and 95 billion per month from September. The Fed had already communicated this figure, so there was no surprise. This will result in a balance sheet reduction of a bit more than $500 billion in 2022. Another element on which the Fed did not surprise, the 50 basis point rate hike. Jerome Powell had already spoken of a rate hike of this magnitude in the preceding weeks, and the Fed therefore raised its Fed funds target range to 0.75–1%. This is a bit historical since this is the Fed's first 50 basis point rate hike since 2000. It was Alan Greenspan who was in charge of the Fed at the time. Let's now move on to the elements on which the Fed surprised, or at least on the elements where it wanted to be rather vague. Jerome Powell heavily insisted on the fact that the FOMC scenario was another 50 basis point rate hike in mid-June and another at the end of July. We would therefore be at 1.75–2% at the end of July, which would correspond to the last median dots for the end of 2022. But the surprise here is that Powell tried to explain that it was impossible to see clearly and to communicate a clear forward guidance beyond 60 to 90 days. And he completely refused to give visibility on the rate policy after July. During the press conference, a journalist asked Powell the question of what factors would determine whether the rate hikes will be 50 basis points, more than 50 basis points, or less than 50 basis points. Powell first responded that the FOMC is not actively considering a 75 basis point rate hike, which rules out the proposal that was recently made by the St. Louis Fed President James Bullard. But above all, Powell explained that the calibration elements for the rate policy after July would be the reaction of financial conditions and the economy to the rate hikes that would be carried out. Of course, he also indicated that the evolution of inflation would be taken into account, and there, surprisingly, after the alarmist remarks on inflation in March, Powell mentioned some progress made on the inflation front, and in particular the slight drop in the core PCE that I mentioned earlier. On this point, if the FOMC is satisfied with such a small drop, you may wonder what will happen when the base effect linked to cars, for example, will come out of the price indices. Given that inflation is likely to have clearly decelerated for the September FOMC, there would no longer be an absolute need to continue with 50 basis point rate hikes. Another interesting element was that Powell re-injected some vagueness about neutral rates. He insisted that this is a concept and that the plausible levels range from 2 to 3% in the long run. What Powell is explaining is that the next two rate hikes would bring key rates close to plausible levels of neutral rates, and on the necessity to go further than neutrality, Powell even said that the FOMC would decide in due course whether it had done enough, while indicating that the FOMC would not hesitate to do so if necessary. In the end, the FOMC's determination seems a little less strong with this press conference, which is a bit unusual when you take into account the 50 basis point rate hike and the pre-announcement of 2 other 50 basis point rate hikes. This comes from probably emerging concerns about the credit markets. For example, Powell mentioned financial conditions 17 times in the press conference, and we can feel that the attention paid to financial conditions is starting to become almost as strong as the evolution of inflation. The Fed wants to curb inflation but remains careful not to damage credit markets. Thank you for listening and talk to you soon.
All comments and analysis reflect CPR AM views on market conditions and its evolution, according to information known at the time. As a result of the simplified nature of the information contained in this document, that information is necessarily partial and incomplete.